Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, New York Federal Reserve Bank President John Williams. President Williams, great to see you. Thank you so much for hosting us here today.
Oh, it's great to be here, and I'm glad that we have this chance to visit the New York Fed.
Yeah, so first of all, let's start off by maybe you telling us a little bit about this historic building.
Well, we're celebrating its centennial this year. This is a 100-year-old building, and we've operated here throughout this 100 years. What's fascinating about this building, we have a gold vault under our building, 80 feet below ground, where we store gold for many other countries, not our gold. So it's pretty cool to have that. But the other thing that's very interesting about this building is how much technology and the work we do has changed over this last century. If you go back to 80 years ago, everything was done with paper. Then we brought in computers. Everything's done with electronically, and then today technology is transformed again and again. And the work we do, the mission we have, is stayed constant. But how we do it has changed over time, and you can see this in the pictures of the trading desk back in the 50s versus the 80s for 2000s and today, and everything has moved from telephones and paper to just very modern technology.
Right, and I guess speaking of the gold, you probably also have a lot of security. I'm sure of that, right?
We
No
do.
doubt.
We are very
just
serious
for
about
anyone
our
taking
security.
any ideas. The New York Federal Reserve Bank, how is that different from the other 11 Federal Reserve banks?
Well, let me start with how it's similar. We all have the same Federal Reserve mission, the same joint responsibilities around monetary policy, the safety and soundness of our banking system, distribution of currency here in the United States and around the world, and other responsibilities as well. The New York Fed, we have a few unique responsibilities. One I just bragged about, which is the gold vault. We're the only one that has a gold vault, again, held here for foreign countries. We also the one bank that carries out monetary policy operations in support of the Federal Open Market Committee's decisions. So when we have our FOMC meeting and the FOMC votes to change interest rates or change the size of our balance sheet, that leads to a directive that is sent here to us at the New York Fed, and we carry that out. I mentioned that we have a trading desk, but we carry out the operations of buying, selling the securities on the Fed's balance sheet in order to make sure that the interest rates are what the FOMC is directed. So that's a unique responsibility here at the New York Fed, but it's done on behalf of the Federal Reserve System, and of course it supports the FOMC's conduct of monetary policy.
From this singular perch that you have, President Williams, what is your assessment of the U.S. economy right now?
Well, the U.S. economy is doing very well. I'll mention a number of fronts. One is economic growth has been very strong. It's been averaging around 3% over the past 2 years, and the latest data show it's continuing to grow in a similar way. The labor market is solid. Unemployment is just a little bit above 4%. And we're seeing inflation come down closer to, but not there, but closer to our 2% longer run goal. So I think, comparing where we are today to 2 years ago, where we had the highest inflation in generations, where we had an economy that was out of balance with supply chain disruptions and all the issues we were facing, we have gone from that point to an economy that is now supply and demand are in balance, the labor market is solid, and where inflation is moving closer to our 2%. When I think about our job at the FOMC as monetary policymakers, it's to continue that progress, keep the labor market in balance, keep the economy in balance, and bring inflation on a sustained basis to our 2% longer run goal.
What's the rationale for the Fed's interest rate policy right now? Chair Powell recently said that for now, quote, it seems like we're right where we need to be. Mm-hmm. What does he mean by that?
Well, I think I'll go back a little bit in time where we saw inflation that was way above the 2% goal, where we saw our labor market out of balance. We had to move interest rates quite high in order to bring demand down closer to where the supply or the ability of our economy to produce was. So it's basically using monetary policy, or tight monetary policy, as we often say, to get demand growth to slow to be more consistent with where supply is. So we did that. We've seen a lot of progress on that. As I mentioned, the labor market, the economy is in better balance. Inflation is closer to our target. target. So now it's time to, say, remove some of that tight or restrictive monetary policy, recalibrate the monetary policy back towards more normal levels. Now, we're not quite there yet because inflation is still a little bit above our goal. We want to make sure we get there and get there on a sustained basis. So I see the adjustments we've made in monetary policy is to kind of move us more closer to more normal levels of interest rates. And we're well positioned to move monetary policy depending on how the economy evolves. The example is if inflation doesn't come down as quickly as I expect, well, then we can go slower about adjusting interest rates to normal. If inflation or the economy slows more than I currently expect, well, then you could move interest rates down slower, more quickly to normal. So I think that's my interpretation. I think interest rates are in a good place in order to achieve our goals of maximum employment and price stability, but it's also a good place to be data dependent, to adjust policy as the economy evolves.
Well, speaking of that, you're fighting this inflation fight, but there's a lot of speculation that the Trump administration is going to pursue policies that may be inflationary. Do you take that into your thinking and consideration?
I think the first thing that I think it's important is that we have to kind of wait and see what policies might come out of any Congress or an administration. So for me, it's like we have to understand what's actually happening, not what's being talked about or being mentioned in the media or something. So with any new administration and with any new Congress, there are actions that they will want to pursue, and those can affect the economy. So the approach I take is let's wait and see what those actions may be, and then do the analysis. Use all of we have a lot of economists in the Federal Reserve. They've studied issues around fiscal policy, around other issues, taken all the evidence and experience from that, and really try to understand any legislation that was maybe passed or something, how that might affect the economy, incorporate that into our analysis of the economy, and also incorporate that into some of the uncertainties around the economic outlook. Because even if you know what fiscal actions or other actions might be, there's always uncertain effects about how quickly they might affect the economy or how big the effects will be. So my view is first, let's wait and see what the proposals are or what the actions may be, and then really sharpen our pencils, do our homework, understand how that affects the outlook, and then incorporate that in our thinking about the economy.
I know you get deeply involved in this particular issue, the natural rate of interest, natural interest rate. What is that, and why is that important?
So the natural rate is kind of the way economists talk about it. I think of it as like the normal interest rate that you would expect that the economy, when it's strong, when inflation is low and stable, and the economy is growing at its trend rate, what's the interest rate you would expect to see in that type of time period? And of course, we don't normally see that. I mean, the economy is always fluctuating, moving up and down. But there's a notion of what the kind of the normal interest rate is. Like we have a kind of efforts at estimating what's the normal unemployment rate in a strong economy or the normal growth rate in a good economy. So I think why is it important? I think it's kind of the gravitational pull, if you will, of interest rates will tend to move towards that. It helps me at least think about what's a normal interest rate and where are we relative to that. And in financial markets, they focus on this quite a bit because they're thinking, hey, interest rates today are here, but where do I think interest rates will be 3 years from now, 5 years from now? If you're trying to price a 10-year bond or think about an investment over a longer period of time, investors and businesses want to think about, well, what are interest rates likely to be in the future? So I think it's a concept that's helpful to think about the longer run situation in the economy. It doesn't really affect my thinking about what should we do at a particular FOMC meeting because there's so many other more important factors driving the economy in the short run. But it is I find it a useful concept to think about what's a normal, a good, strong economy look like, and where are we relative to that today?
Growth has been relatively robust, President Williams recently, but how do we sustain that?
Well, when I think about it's really about the supply side of the economy. Demand can help keep the economy near its potential, but so really what's it about is how do we how do you improve the potential growth rate of the economy? And there's two factors that very broadly. One is labor force, making sure that everybody is able to work, who wants to work, and having a strong labor force and has the right skills and the training and education. That's one of the biggest drivers of growth in the U.S. economy and around the world, is really what we call human capital. It's the experience and education and skills and training that our workforce has. The second is really around innovation and productivity and investment. And we've seen very strong productivity growth over the past 5 years, which is a fabulous development, and I hope it is sustained. But I think a lot of that is coming from new businesses being started. The entrepreneurial spirit in the United States is very strong, and people are creating new businesses, especially after the pandemic and everything, to say, like, getting a lot of opportunities with new technologies or new business ideas. So I think those are some of the big factors, but they're really on the supply side of the economy. It's about the investments we make in people, in innovation, and also in the kind of the infrastructure of our economy. So those are the things that I think that matter the most. And the good news is we are actually seeing productivity growth in the U.S. that's much stronger than any of our peer countries among major economies in the world. So things are going well here on our side, here in our country.
I was so surprised when productivity took that dip, given that technological expertise in the country continued to be rolled out, I guess is one way to characterize it. So what caused that? Because I thought it was so technology driven.
Well, in the short run, I mean, productivity can be affected by where the economy is and the business cycle and things. But you're asking a deep question that economists have thought about a lot, and I don't think we have all the answers. But one thing we have seen in the U.S. economy, which does have very strong productivity growth over long periods of time, is that there tend to be periods of a decade or two where productivity growth is much higher than average. And it's usually driven by some major set of innovations which can drive changes in technology and the way we do business throughout the economy. Going back, if you go back over 100 years, you're talking about the movement off of, movement away from agriculture to manufacturing, the electrification of our economy, the creation of computers in the post-World War II period, and all of that. So there are periods where there's some major breakthroughs where businesses and people say, I can do things I've never done before, I can do them differently. So I think, when we've had slower productivity growth, we haven't had negative productivity growth. We've always had productivity growth. It's just been slower. And I think it's, we had a period between 2006 and up to the pandemic where there weren't these kind of major breakthroughs. There was a lot of technological advances, but I don't think they were changing how we do business in the U.S. as much as some of the others. Now, there's some there are some possibilities that we're seeing that with AI. Right. That's an open question. I'm not going to make a prediction about how transformative AI is, but I think it has a similar flavor that it will affect businesses throughout the country and, quite honestly, throughout the world.
How do you respond to criticism that the Fed's tools are too blunt, that, for instance, the policies really just help wealthy and perhaps even exacerbate wealth inequality?
So we do have a very limited set of tools. We basically, at the end of the day, are either raising or lowering interest rates in order to affect demand in the economy and to achieve our maximum employment and price stability goals. Now, these are incredibly important goals to achieve. I mean, as we've seen when inflation rose a few years ago, that hit families extremely hard. For people who have modest means, higher prices meant you had to cut back on other things. Paying your rent became challenging. So price stability is really important. Obviously, maximum employment, having a strong labor market, and having jobs for people, these are really important. But our tools are really just around interest rates. So my answer to your question is that a lot of the issues that people want to address in our economy, maybe about education or workforce or other things, these are addressed through other tools. They're addressed through actions of elected officials, maybe state and local government, federal government, around tax policy or government programs. And so we have a clear mandate of maximum employment and price stability on the overall economy. We have a limited set of tools, and we use those. A lot of the other issues, the vast majority of issues, I would say, in our society and our economy are really properly addressed through the tools that elected officials have and get to decide over.
I want to ask you about the Fed's independence and how important that is and why. And wouldn't it be better, President Williams, if the Federal Reserve was coordinating its activities with the executive branch and Congress to really steer the economy? Wouldn't that even be better?
Well, I do think independence of central banks, not just the Federal Reserve, is very important for monetary policy. So when I think of monetary policy, which going to your previous question, is we have a very limited set of tools of interest rates. We have a very limited goals, maximum employment and price stability. Extremely important goals. In extremely important tools that we have, but they're very focused on these narrow issues. We can't make tax policy, we can't make other policies, we just have tools we have. And so in terms of the independence of that action, we've learned, I think, from our own history, but also from the history of other countries around the world. And the evidence shows that independent central banks with a clear mandate for price stability, or in our case, maximum employment as well, have done better at achieving those goals than central banks who have, are more part of governments. And I think it's a big driver of that is the ability to just focus on the work that you have. Not be swayed by short-run political considerations or other considerations, and just, you could think of this as being the kind of just doing the job that we have in front of us. So I think experience around the world has shown this has worked. I think the past 5 years, which have been extremely challenging, inflation rose almost in every country, but what we've seen is independent central banks around the world taking the hard actions, raising interest rates in some cases. You look in Latin America, much higher than we did or other countries did, taking those tough actions, bringing inflation back down. I think the proof of the power of the independence of central banks has been proved again in this experience of the past 5 years. So I think this is very important. Again, going to your question, the elected officials have the responsibility and the ability to make the decisions on all of the other policy actions that matter for the American people and for our economy. And those are things we don't do and we don't opine on. And so I think that those, our job is to keep the economy strong and keep inflation low, and then the elected officials, are rightly focused on all the other issues that need to be taken care of.
Shifting gears a little bit, I want to ask you about leadership. How would you characterize your style or notion of leadership?
Well, I think the first thing is you have to have in any leadership role is a clear vision of what you're trying to achieve. Clear set of goals, clear set of what I always say, what does good look like? What are we trying to achieve? What does that feel like? What does it look like? And it could be a technical issue, it could be a cultural issue, it could be whatever, but let's be clear about where we're headed and what we're trying to achieve. That's number one. And people always want to have a clear idea of where we're going. And I understand that. I completely agree with that. The second is having the very best talent and people who bring great ideas, diverse perspectives, and who can come together and figure out how can we best achieve that. None of us individually know the answers to most questions. We all know from experience that we learn from each other, we learn from people we disagree with, or we learn from people who bring a different perspective. So it's really bringing people who share a vision of what we're trying to achieve in their organization and have a clear understanding of what that is, and come up with the best approaches to that and help us implement that. And I think that the key to all of this is just something that I experience all the time, which is the decisions we make, the ideas we have when we do it together and we learn from each other are always better than the one you entered the room with. And getting people who bring that and can move that forward. I do think, I apply this same kind of thinking to monetary policy, interestingly. We have clear objectives with our long-run goals, our 2% inflation goal. We all agree on where we're trying to get, but everybody in that room brings a different perspective, a different background, a different viewpoint. Mm-hmm. And we are better because of that diversity of viewpoints, the fact that, I may see the one issue on something one way, another person sees another. We're better because of that. And at the end of the day, we have to make a decision. And this is the last thing I want to make, is the key to leadership is, at the end of the day, you have the debate, you have the discussion, you need to make the decision and execute that decision and learn from that. And so again, in whether you're leading an organization or doing monetary policy, the FOMC at 2 p.m. We're putting out a statement. We're not going to kick the can down the road. We're gonna decide what's best then, and obviously come back and revisit that every time.
All right, speaking of divergent opinions, are you ready for a fun question?
Okay.
Okay. Fed Chair Powell is known to be a fan of the Grateful Dead.
I am fully aware of
Deadhead,
that.
okay?
I know.
You are known for liking more modern music, rock music, punk rock music even. Do you guys discuss music, and do those cause any friction or clashing?
First of all, Chair Powell is incredibly knowledgeable about music of that era, which I also enjoy a lot of that music from that same era, the 60s, 70s, and
being a Californian, especially.
Yeah. So we do talk about music a bit, so I feel like music is something that everybody has their personal preferences. Our musical tastes often get cemented in our formative years, and when you're in high school and college or whatever. To me, the diversity of views on music is actually extremely refreshing, and it's fun. But it is definitely a passion. I would say both for him and for me, and of course we all debate about which is the best album and things like that.
Right. And final, last question on a more serious note, President Williams, how sanguine should U.S. investors be about the U.S. financial system, and why?
So the U.S. financial system is has such strong fundamentals. And so a question I often get asked is, well, is the dollar going to lose its luster in global markets? Are we losing something there? And I always go back to kind of the fundamentals. We have an extremely strong economy, strong fundamentals. We have a dynamic economy, so we have very strong fundamentals, not only in an absolute sense, but relative to some other countries. And we have very strong institutions. And we've shown that when there's experience teaches people that when there's a crisis, wherever that is, whether it's the pandemic or it's a financial crisis or something that's happening in another country, what do global investors want? What do global investors want? They want their money someplace that's safe, someplace that's liquid, someplace that they can move it in and move it out, and that's the U.S. dollar, that's the U.S. economy. So, we're very focused here on the New York Fed about, making sure that the Treasury market is, functioning extremely well, the financial markets are working well. So we're always looking at, all the issues around that, and we see where there are stresses and things. But when, what's really remarkable is despite everything that's happened in the last few years and a lot of the volatility in the data and the shifts in monetary policy to rapid increases in interest rates and now interest rates coming down, our financial markets have operated very, very effectively. They've done what they're supposed to do. It's very important that they do that. But I think that is one of the great strengths of the U.S. economy, our capital markets, our banking system. We have we are the financial center of the world. And it's because of these fundamentals that we have.
New York Federal Reserve Bank President John Williams, thank you so much for joining us and for hosting us here.
Great. Thank you.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.